Thank you for joining me for a very special edition today. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Friday, May 1st, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. The S&P 500 was down 2.81% today, and we closed at 2830.71. The first chart we're looking at is an intraday chart of the S&P 500 where each candlestick represents 1 minute of trading. And as you can see here, once we opened up, we pretty much traded down to this 2822 level and then went sideways from there and closed towards the lows of the session. So one thing about next week is we'll have to keep our eye on this 2822 level to see if that, again, next week acts as an area of support, or was it just short-term support for today's trading. Earlier this week, we closed right at the 61.8% retracement of this entire move that we've had from February 19th through March 23rd, where we bottomed so far. Nobody knows whether that's going to be the ultimate bottom of this downturn or not. And then, of course, once we started rallying up on the back of less bad news about the coronavirus, as well as trillions of dollars of stimulus from the U.S. government and governments abroad, then we were able to have this multi-week rally here that brought us up quite a bit off the bottom. And again, Wednesday we closed at that 61.8% retracement level, and we have been from that point rejected from there. We've had a couple of pretty bad days in the market here on Thursday and Friday, and of course today you can see that we closed beneath this 2850 level. So we'll have to keep our eye on that. 2850 now becomes the overhead resistance point once again. So we'll have to see if we can get back above that next week or not. The other thing to keep our eye on here is this area right around the 2800 level. To be more exact, 2792.69. That is the 50% retracement of this move. So the question becomes here, with 2850 being the overhead resistance level, what level of support will we stay above next week and the week following? Will it be 2800 or will we go below that? Now what we're looking at is a 3.5-year chart of the S&P 500 where each candlestick represents 1 week of trading. And of course we know that 2850, this blue line here, is our overhead resistance point. We got up to that 2950 level this week and got rejected, and you can see on the weekly candle, it's a pretty negative candle there. During the entire rally here off the bottom from March 23rd, we've been able to close 1 week above 2850. So this 2850 level is it's acting as a real overhead resistance point. So we'll definitely want to keep our eye on that going forward. The question now becomes, can we stay above this 2750 level, or will we drop below it? Have we lost our momentum here, and are we going to roll over and go down from here? The next level of support beneath us is around this 2750 level. On shorter term charts, we know that we were trading above 2727 for a couple of weeks. So somewhere between about 27.25 and 2750 where this line is, we do have some support. If that area does not hold, if indeed we continue to roll over from here for a while, then 2630 is the next area of support that will kick in. And now I have some very special research that I want to share with you. I know you're really going to like it, so please stay with the rest of the video. Okay, so now what we're going to focus on is the yield on the 10-year Treasury over the last 5 years, and really focus on the last couple of years, because I want you to understand how the interest rates have fallen over the last couple of years and the effects that that has had on certain sectors of the equity market. So what we're looking at here is a 5-year chart of the U.S. 10-year Treasury note yield. You can see that here in the upper left. And what we can see here is yields over the last 5 years. The highest yield we had on the 10-year Treasury was back at the beginning of October of 2018. And it's easier to see when we focus on just 2018 on a weekly chart. So each candlestick now is a week, as it was on this chart as well. But I wanted to start on the 5-year so you can clearly see that the highest yield we had over the last 5 years on the 10-year Treasury was right here. But again, when we zoom in and we just look at 2018, calendar year 2018, you can see that right here was kind of that peak in yields at about 3.25. So roughly 3.25 on the 10-year Treasury was about the highest we've seen over the last 5 years. And we know that yields have fallen dramatically since the beginning of October of 2018. And going back to the 5-year chart, you can really see what has happened. We went from about 3.25 down to about 60 basis points. It's just unbelievable what has happened to the yields on the 10-year Treasury. But now let's take a look at what that has done to certain areas of the equity market, because I think so few people understand this. So what I've done now is these are the sectors of the S&P 500 along with the S&P 500. So we have all 11 sectors here. And of course, we're using the ETFs to get exposure to these sectors, to track those sectors and do this analysis. And so you can see the ticker symbols up here if you're interested. The time frame we're going to look at here is October 1st of 2018 through February 19th of 2020. And of course, that was the peak in the U.S. stock market back on February 19th. So I want everybody to understand what happened between October 1st of 18 and February 19th of 2020 when we lift up the hood and look inside of the S&P 500. How did falling interest rates affect some of these sectors? So what we can see here, and we'll just do a quick left to right. So the S&P 500, excluding any dividends on any of these things, okay, but between October 1st of 18 and February 19th of 2020, what we can see is the S&P 500 was up 15.78%. Okay, that's the whole S&P 500. The consumer discretionary sector was up 15.17, so almost kept pace with the overall S&P, but it was slightly behind. We had communication services up 19.41%. Technology, of course, was one of the biggest gainers, up 38.20. We had industrials up 9.23, materials up 6.29. The energy sector was down 23.05% during that time frame. Consumer staples up 24.08. Healthcare up 11.81. Utilities up 39.17%. The financial sector was up 15.45, and real estate up 33.04%. Now, the sectors that are going to be the most interest rate sensitive and therefore benefit from falling interest rates. Now, some people would argue, oh, what about financials? Well, financials, guys, need higher interest rates, okay? So falling interest rates actually hurt the financial sector. So what we really want to focus on here are the sectors that benefited from this massive drop in rates. The sectors that most directly benefited from falling interest rates would be the consumer staples, the utilities. I mean, look at this. Utilities was the best performing of all of these sectors during this time frame from October 1st of 18 through the 19th of February of 2020. Should utilities have really outperformed technology during that time frame by about a percentage point? I mean, really? Does that make any sense? I want everyone to understand what's happened since October of 2018 and how these falling interest rates have affected certain areas of the stock market, and therefore it will help us when we look forward as to things we might expect, okay? And of course, real estate would also benefit from falling interest rates, so it was up 33.04%. Aside from communication services, the only sectors that outperformed the overall S&P 500 since October 1st. Technology, which makes a lot of sense, right? That's the real growth engine of the economy to a large degree. A lot of stuff is affected by technology. So it does make sense that this would be one of the best performing areas of the stock market. And it's not really going to be that affected by falling interest rates, okay? But look at these other really conservative, low growth, slow growth areas that drastically outperform the S&P 500 from October 1st of 18 through February 19th of 2020. You had consumer staples, plain vanilla, boring companies, up 24.08% in that sector. Okay, again, a direct beneficiary of falling interest rates because these are companies with slow growth, a lot of debt, and they're very conservative, and so falling interest rates really helps their balance sheet in that they can refinance debt and lower their cost of capital. All right, so that really helped them. And then you've got utilities. Again, utilities, the best performing sector of the S&P 500, even outperforming technology during that time frame. Utilities up 39.17%. And again, we know that utilities, boring, slow growth companies, a lot of debt, very interest rate sensitive. So falling interest rates really helped out the utility sector. And then, of course, real estate. We know that that's a very interest rate sensitive sector, so it makes a lot of sense that real estate would benefit from falling interest rates. Real estate up 33.04%. So I hope this gives you some serious perspective when we look at the S&P 500, and this is now a 5-year chart of the S&P 500. Each candlestick represents 1 week of trading, and we can see here in 2018, October of 18 right here, okay? So this is this time frame we're talking about from right here until right here. October of 18 through February of 2020. The best performing sectors during this time frame were those highly interest rate sensitive sectors that would benefit from falling interest rates. So those that benefit from falling interest rates, consumer staples, utilities, real estate, they're going to be the ones that are going to benefit the most from falling interest rates, and that is exactly what happened here, okay? So when people say we had such a raging stock market over the last couple of years, I hope it helps to lift up the hood of the S&P 500 and take a look at that exact time frame to see what really worked. We want to see things like technology and communication services outperforming the S&P 500. That is healthy. But when we see utilities being the best performing sector of the S&P 500 during that time frame, okay, from here to here, that to me is not an overly healthy thing. And then when we see consumer staples right behind that, real estate, again, that's a pretty good thing, right? I have no problem with that. But when we see these low and slow growth sectors really outperforming everything else, and everybody thinks the economy and the stock market were so wonderful right here, I hope this helps when you look at this to really get your head wrapped around the fact that aside from technology, the market was not that strong during the last couple of years. Now let's take a look at what has been going on in the stock market over the last couple of years in a slightly different way. So what we're looking at here is the 5-year chart of the S&P 500, and I've overlaid the MS World X US Index on top of that. So that is this black line here. The MS World X US Index is an index that tracks stocks in 22 developed countries. There's over 1,000 holdings in this index, and it represents about 85% of the market cap of the developed nations around the world outside of the U.S. And what we can see here is that this index peaked in January of 2018. So we had weakness coming into where we peaked. If you go back and look at what happened in 2016 and 2017, you can see that the U.S. markets and the rest of the world were going in the same direction. But we had a negative divergence here starting in January of 2018. We never hit that peak again. And you can see that the MS World X-US Index actually started to roll over at the beginning of 2020, really in January, first part of January, where we peaked in February. So again, just another way of looking at the fact that even on a global scale, we weren't seeing the super strong stock market like we had in 2017 and even back into 2016, but especially 2017, everything was going up together. That's what you want to see. But of course, the MS World X-US Index peaked in January 18, and that is so far the high of that index. Another way to look at this is when we look at the same 5-year chart of the S&P 500, but overlay the EEM, which is an ETF that tracks the emerging markets. And again, we can see that the ETF, the EEM ETF, peaked in January of 2018. Again, it just shows that these stock markets over the last couple of years haven't been as strong as what most people think. And then when we look at the U.S. small cap, so we're looking at the Russell 2000 now, the IWM, which is the ETF that tracks the Russell 2000 small cap index. So these are 2,000 small cap companies domiciled and listed right here in the U.S. And again, we can see that the index, right, peaked in 18. Now, it peaked a little bit later, where most of the global stuff peaked in January. The Russell 2000 index peaked in the summer of 2018. It rallied back and tried to retake its high, but it fell short in January of 2020. Again, started to roll over a month before the large caps. So again, regardless of how you look at this, the last couple of years haven't been as strong as what I think most people believe. Yes, optimism about the future is fantastic. Capitalism will prevail, and the stock market will eventually move on to all-time highs. Companies that make up the stock market will eventually, in the aggregate, earn all-time high record earnings. But that is not the environment that we have right now. So we have to be realistic about what we're working with, okay? So I would encourage you to be patient and be careful here, because there is still a tremendous amount of uncertainty and risk in these markets. I hope you've enjoyed today's session. Please remember to subscribe to this channel, give me a thumbs up on this video, and check out some of my other educational videos on my channel. I have a lot of fantastic market-related videos on this channel. Also, if you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, your 403b, your IRAs, or of course your trading account, I would encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about how Simple Market Signals can help you in both up and down markets, here is some additional information. As part of the Simple Market Signals model, there are two powerful indicators. There's a risk-based indicator and a trend indicator. As a subscriber to Simple Market Signals, you will receive information on what the risk level is in the overall stock market, as well as what the trend direction is in the overall stock market. So this really, really helps. The way we disseminate the signals to our subscribers is via our weekly emailed newsletter. So within the newsletter, every weekend, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the early bird indicator, the trend direction signal on the overall U.S. stock market. You will have market and sector performance information on multiple time frames. You'll get market commentary and a weekly recap of what happened in the market. You'll have technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information in this newsletter every weekend. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and your first 2 weeks are free. Now let's recap what you get with your subscription to Simple Market Signals. You get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there is a major signal change or direction change, we're not going to wait until the weekend to get that information to you. We will send out a special midweek update when necessary to keep you up to date as to what's going on within the model. And the best fit for a subscriber for Simple Market Signals is somebody that has at least a 6 to 8 week time frame or longer. So if you're a long-term investor, you're going to love this. If you have at least a 6 to 8 week time frame that you focus on with your trading and investing, you're going to love this. If you're an ultra short-term 1 or 2 day trader, kind of a day trader, or somebody that trades within a week, Simple Market Signals might help you a little bit. But the reality is, the people that are going to benefit the most from a subscription to Simple Market Signals are those people that have at least a 6 to 8 week plus time frame that they're focusing on. And if you want even more information on Simple Market Signals and some of the strategies that you can use on the various signals, this is a very in-depth video that I will have linked in the description box below this video, along with a bunch of other videos that you may want to explore if you need additional information on Simple Market Signals before you subscribe. Also, keep in mind that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. And to subscribe to Simple Market Signals, all you have to do is go out to the website that you see here, https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that simple.